Good evening and welcome to tonight's webinar. My name is Brian. I will be your host / conductor. We will be talking about MACDs and bearish divergences, and I've found some fantastic examples for you guys to take a look at tonight. Before we get into things, if you have questions, please go ahead and use the questions function. As I said in the marketing piece that you received, that you probably signed up through, questions make the webinar a lot better. If they're questions about a personal situation, then I may not choose to answer that and may say follow up with me, hence you have my email there. But if there's something that will add value to the topic, then I'll go ahead and discuss that for sure. So ask away. My daily market commentary, I actually am using this webinar as my daily commentary today, so I didn't post anything as of yet. I may get something written later, as it actually was a fun day and there was a lot going on, but you have the link there. This is also duplicated at the daily Forex Trading Edge page, which I'll give that link to at the end of the webinar. So let's move into things, but as always, I'll let you read or do whatever you'd like with this disclaimer, but please know it is very important. And again, the disclaimer is important. You're trading a leveraged product. Anything can happen. There are no guarantees. Tonight we're talking about education only, so there are no buy, hold, or sell recommendations. Please take that to heart. Outline of where we're going. We're going to do a quick catch-up of fundamental analysis. A lot took place today, so we'll discuss that. Technical analysis. We'll combine the technical analysis, live market examples, major trends, support, and resistance with tonight's topic, since it is technical analysis itself, the MACD, moving average, convergence, divergence, and then looking at the bearish divergence. And I did this on purpose. The webinar I did 2 weeks ago talked about moving averages and trends, and I was hoping that at some point some of these trends may get overdone and we may have a chance to look at some divergences where the trend going up in equities or the trend going up in most currencies out there except for the US dollar would be starting to turn around a little bit. And you guys know that that's the major market relationship that we saw today. For the most part, when you have equity prices going up, the US dollar is going down. What did we have today? We had the equity prices going down and we had the United States dollar going up. So hopefully you understand that. I reiterate that daily in my blog, and I reiterate that every 2 weeks as we go through these examples. So if there's a trading edge out there, that is one that has been out there. Again, stops, proper trading management, proper account risk, trade risk, because nothing is guaranteed out there. And then we'll just review what we talked about tonight. All right, fundamental analysis, discussion of current events and what they mean for traders and investors. Forexfactory.com, which you link directly through from IBFX. I'm going to bring it up. I already have it ready to go and loaded. It's a very important site. I'm going to show you that. CNBC, or the worldly version of CNBC, depending on where you are around the world. If you're trading at hours that aren't the U.S. equity session, whether it's the Asian session or the European session, then obviously you want to have the worldly version up there. Bloomberg TV does stream on the internet. At Bloomberg.com is a great site as well. Your broker is providing fantastic fundamental analysis. Raggy Horner, a lot of you know of and follow. She's providing very good data, and the other analysts that work with IBFX. And then obviously you probably all have your own specific market sites that you use. Be careful of having too much information, but obviously as long as you know how to use it, then it can benefit you for sure. So forexfactory.com, what's going on today? Let's go ahead and take a look at it. So this is, it is a very busy week, as I've talked about in the blog. Last week wasn't as busy, but this week is much more active as far as the foreign currency calendar goes. So just waiting for this to load up. So just bear with me as it loads. Or should be loading. There we go. All right. So this week, and again, you know, a lot of people focus on U.S. data just because that's driving the markets, and we know that there's kind of a cause and effect relationship. What happens in the U.S. sometimes follows through, or most of the time follows through to other currencies. Today is Wednesday. Today we had a big red event on Forex Factory. Federal Chairman Bernanke testifies. If you don't know what he said, shame on you, because when Bernanke speaks, the markets listen. When the ECB, European Central Bank, speaks, the markets listen. When the Bank of Japan speaks, the market listens. These are the biggest traders out there. So Bernanke is speaking in his semi-annual testimony to the Senate and the House. He spoke today. He's going to speak again tomorrow. Most of it is the same information, but the point is he is speaking tomorrow, so be careful of that. So you can click on these articles to read about it, but to summarize it, people are asking about more easing, more accommodative policy, more chance of lower interest rates for an extended period of time. He didn't say it. It was kind of like a no comment. The markets got a little bit worried on that because they want him to say, we're going to keep helping you out. We're going to keep helping you out. We're going to keep helping you out. Well, today he didn't necessarily say that. So what happened? The dollar strengthened. The equity market went down. The dollar strengthened because, hey, is he telling us that at some point we're going to end this accommodative easing, because he didn't say we're going to continue it today. So that's something you have to be aware of. Like I said, he is speaking again tomorrow, and you can see that right here. At 10 a.m. Eastern, we also have manufacturing data, which has employment components to it. We also have our weekly unemployment claims. So lots of data. I'm not saying that this is going to drive the market. You will have a trading opportunity off it. But as a trader and as an investor, you have to know what's going on out there. Right now, fundamentally, the markets aren't really paying attention to this economic data like they usually do. They're paying more attention to what's going on in Europe on a big scale, what's going on with the ECB helping out European banks and funding them, what's going on with, just a moment while I just have a tickle in my throat and catch a drink of water. Sorry about that. So again, this economic calendar basically is what I'm saying is taking a backseat to the bigger international events, which is European austerity, overall credit cycle, interest rates for the long term in America. They may come back into focus, meaning these economic indicators, and when they do, we'll have an understanding of, are they getting better, are they getting worse? As of late, fundamentally, the United States economy has been smoking along so very, very well. The first time we've had a kind of negative number was actually yesterday with durable goods, which is right here. So Tuesday you had durable goods right here expected to be flat, down a little bit from last month at 2.1, and they came in at negative 3.2, a big down move. Did the markets go down yesterday? No, they went up. So that's what I mean by you have to be able to focus and understand what is driving the markets. And like I said, central bank policy is driving the markets right now. Let's move into technical analysis. And as I said, I'll pause and look for questions. So I hope that you guys are all asking questions. So I'm just pausing to take a look and see if there are any. But that's what makes these a more well-rounded webinar, where I can go off into tangents that I might not normally go into if the question's not answered. So please ask away. Pretty straightforward from the fundamental side. Technical analysis. What are the traders doing with the fundamental news? What are the major trends, support, and resistance, and some live intermarket relationships? Let me just jump to the next slide, since we're going to be talking about technical analysis in our main topic for tonight, the MACD. What is the moving average convergence divergence? When is it designed to be used? The crossover method is what I'm going to be showing you. So a bearish crossover is what we're looking for. So and then managing the indicator, not just the indicator itself, but combining it with our other knowledge, fundamental and technical analysis. So I never say that there's a holy grail out there. The holy grail, as you well know in my trading psychology webinar, is you. Once you understand yourself and your trading personality, then you can use these various technical indicators and fundamental analysis to adapt them to your needs. So just before we go into the MACD and into the markets themselves, let's show you what's going on with volatility. I always talk about this. This is the volatility index, and I think it's very important that we understand that as traders, this fear gauge, uncertainty gauge, anxiety gauge has been going down, and that's just something to think about as you're looking at trading ranges and things like that. Today, what happened to that volatility gauge? It went up a little bit. Why? Well, the markets went down, so a little bit of fear and uncertainty to the upside. As the equity markets go down, that's to be expected. If you flip this chart, and I'm just going to go ahead and type in a new chart, and I'm going to type in the overall equity market, just so you can see it. Okay, and you're going to see them side by side. Here's the volatility index last summer, high, going lower November, December, January, February. Here's the stock market last summer, low, going higher November, December, January, February. Do you see that they look exact opposite of each other? So as the equity markets go higher, volatility goes lower. Intraday trading opportunities may be going down as volatility goes down. Are you over trading and scratching a lot of trades? Then you might be over trading for these market environments. I'm not saying that low volatility is a bad market to trade in. I'm just saying it's a different market to trade in. I have to approach the amount of pips I want to get differently. I have to approach the frequency of my trades differently. Today was a bigger trading range day in Forex than we've had overall, and I'll show you that in just a moment. So that's a very, very important relationship for you guys to see, okay? You have to understand what volatility means for trading opportunities. So it looks like our first question of the evening is coming in, so let me just go ahead and take a look at it. Is that typical for them to react like that? Absolutely. Very, very typical. I could bring this out actually to a longer time frame. Let's see if I can get the periods up here. It'll let me move my cursor on it. So I'm just going to kind of scroll out so you can see. I'm going to just move this cursor over just a bit so that you can see what was happening prior to last summer. So look at this as we line this up pretty much exactly. Okay? Do you guys see a relationship here? These relationships exist in the markets. That's why I call it intermarket relationships. So it's not only the VIX, it is Forex, Australian commodity as far as gold, and Australian currency. Sometimes there's relationships. U.S. dollar as a whole against equity prices as a whole. These are killer relationships, guys, that you should be searching out and you should be understanding. I don't just trade Forex. I look at stocks. I look at options. I look at futures and commodities and things like that and bring them all together. And that's what I work with my clients, is making sure that they understand this. If they're invested heavily in the stock market or invested heavily in gold, how can we use the Forex markets to hedge? How can we use the option markets to hedge? You guys, a lot of you may be invested heavily in the financial markets, and they've done very well. A more telling sign, as I look at the S&P over a longer term time frame, and I'm sorry if this won't come up. I'm just trying to get the time frame, the periodicity here. Here we go. Let's look at the S&P as the data comes up over a longer term time frame. Do you guys know that the S&P has gone up 100% in 3 years? So I'm going to change this periodicity one more time to get a better handle on it. But we've gone from about 700 or so, 650 in the S&P, to 1,300 in 3 years, 100% return in 3 years. Very, 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 very big return. So that's something to remember, okay? We've jumped really, really, really large amount. Is that going to continue? I don't know for all of you investors. Now you look at the VIX and say, hey, the VIX is low. If the stock market's going to go down, the VIX might go up. Maybe I want to hedge. All right. Maybe I want to use the VIX to hedge. Maybe I want to use some product out there to hedge. Maybe I want to use foreign currency to hedge. So these relationships are very, very, very important. So going back into and getting closer and closer to the MACD, as I just check one more time for questions. Okay, perfect. So what I want to show you now is, now that we have a better handle of volatility, now we have a better handle of the understanding between that and foreign currency markets, or the equity markets, let's move into foreign currencies and just give you kind of some background. And I'm going to use the euro for this. I'm going to blow up the euro, and I'm going to show you. Remember, the stock market's been rallying, rallying, rallying. Of course, we know that things have happened in the euro where that's been specific to the euro region and things have changed. So the euro, as when the stock market was rallying November, December, January, February, well, obviously the euro wasn't rallying until it went down and found fair value as of late. Compare that with the Australian dollar, and let's see what the Australian dollar was doing over that same time frame. It's been going up since November, December, January, February, March, and these are big moves, guys. 98 cents to 108, 10 pennies. Stock market went up, commodity prices went up, U.S. dollar went down, Australian dollar went up. So something specific to the euro currency didn't make it do that same move that the commodity currencies did as oil went higher, as gold went higher. These relationships are important to know, cross-market relationships. This is what I write about in my blog. This is what I talk about in my webinars. This is what helps you become a more savvy, more quote-unquote dangerous trader, meaning dangerous, meaning more sophisticated, better, higher probability trader. Again, trading plans for each and every individual, each and every trade, each and every situation are of essence, because anything can happen at any time. Trends can stop, trends can reverse. We're going to look at that. So the euro is going up, 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 and you know that I like Fibonacci's. Here we are at a major 50% retracement right here. Bring this down to a 1 hour chart. A lot of you love chart patterns. I love chart patterns. What is this chart pattern right here? Potentially a double top, or not potential, it is happening. It is a double top. If you understand resistance, we were resisted here last week on the 24th of February. We were also resisted here basically today. And as you understand this relationship, if the stock market goes down, in theory, the United States dollar should go up, which makes the euro weaker, obviously. So here you have a double top, and you're saying, wow, what a big move. 29, 30, 31, 32, 33, 34, 35. Big move up. Is the euro that good to keep going? Is the stock market that good to keep going? Hey, maybe I'm invested in the equity market. Maybe I'm nervous that at 13,000 we're going to run into a little resistance. If we run into resistance and go down from 13,000, historically, the stock market goes down, the dollar gets stronger. I could buy the dollar by selling the euro here and protect my equity investment. I am now hedged using foreign currencies. Maybe I'm a short-term foreign currency trader, but maybe I use this longer-term picture as a good place to get short. I have a 50% retracement. I have a potential double top. My risk reward to get short here and risk 50 or 75 pips to make 100 or 200 pips is in my favor, and that's a trading plan I put on. I get in around 34.50 or 60, put my stop at 35.25. I risk 50, 60, 70 pips, and if it goes my way, 100, 150 pips, great. 34.50 is my entry. We're now at 33.50. I've got 100 pips. If the stock market goes down again tomorrow, I should get another gain. I start moving my stops down and down and down and locking in profits using my technical analysis. This might be my neckline right here. I'm not talking about double tops tonight. I'm talking about moving average, convergence, divergence, and then the bearish diverges on it. So let me put this up, you guys. Very, very good chart to put this up on. Insert. So I want to insert my indicator. What kind of indicator? MACD is a oscillator. So there it is. The definition of it is it helps me in this version of it. Remember, I did moving averages 2 weeks ago, which work on trends. Today, I'm talking about using moving average, convergence, divergence, to tell me when a trend is finishing or could be potentially finishing. So it's an oscillator. It's telling me things are overbought or oversold and going to reverse. So here's my MACD. I put it on the chart. Gerald Appel invented this, so I'm not going to show you the definition of it. If you want the definition of it and the ins and outs of it, go to Investopedia, go to your Google, and go Google it. I don't need the definition of it. I know how it works. I'm teaching you how it works and the rules behind it and how to use it fundamentally and technically. I think we've talked about some fundamentals and technicals to manage it. So let's go down to a 1 hour chart. So here we are with the stock market at 13,000. Here we are with the euro going up and up and up, hitting 34.85 roughly up here, going back down and heading back up. What is the MACD doing? This histogram here is showing me the difference between over here on the left, the 12 period moving average and the 26 period moving average. The farther these histograms go up, the further the 12 and 26 are diverging and basically getting stronger and stronger. The 12 is really racing up and the 26 is kind of following it. We have an uptrend. Well, then we back off. Great, the MACD backs off. And I'll put on my crosshairs up here in the upper left. Then we go up and the price basically makes a double top, maybe even inches just a bit higher. The high here, let's see, is 34.82, 34.84, and the high here was 34.85, so it basically makes the exact same high. Where is the MACD? Two moving averages diverging from each other, and the 12 and the 26 are not showing the same strength. Price is making a high, so based on the histogram, if the price is just as high, my histogram should be in the exact same place. My histogram is a lot lower. My histogram is showing me that the price is running out of steam. I have a trend up. I have to decide if I want to go against that trend, which can be very, very dangerous. So I have to combine other information. I combine equity market understanding and what it's doing at 13,000. I combine a double top. I combine a 50% retracement. I have 2 or 3 moons lining up. I could even add another indicator in. What indicator is an oscillator just like the moving average, convergence, divergence? This is why you don't need analysis paralysis and to have 8 indicators on there because you'll never make a trade. You have one indicator, you use other fundamental and technical analysis with it, like chart prices. But if I want to put in another indicator that is an oscillator, just to prove to you, I'll put in my relative strength index, RSI. Okay? What is the RSI doing here? And what is the RSI doing here? It is lower. The strength of the relative strength index isn't saying, I agree with you, Mr. Price action of Euro US dollar. So in a bearish divergence, or opposite would be a bullish divergence if the markets were trending down. In a bearish divergence, you go the direction of the indicator if it can't satisfy the same exact thing. Okay? If it's not experienced the same action that the price is. Very, very important to understand here, guys. That's what you're doing. You're using the indicator to say, I'm going to enter going short on the Euro US dollar. I put my stop in the appropriate place. I put my target in the appropriate place for the time frame. So I don't care if you're a long-term trader or short-term trader. You can both get in for the same exact indicator, the same exact time frame, and using it, put your stop maybe a little bit different. The stop might be tighter for a short-term trader versus a long-term trader. The short-term trader might be out here and they make 20 or 30 pips, yahoo. The long-term trader might be saying this is a longer-term trade, a longer-term hedge of equities, whatever it may be, and I'm in it for 100 or 200 pips and I'm in it now and maybe I've moved my stop down to break even because I'm managing the trade. Because you know what? Tomorrow the stock market could go up 200 points, and if that's the case and there's a relationship, the euro might go up 200 pips. So I move my stop down to lock in my profits or to protect my profits. I am managing, or I call it massaging the trade. Not a set it and forget it, not a trailing stop, which might work, but I always want to check back and understand. If I look tomorrow and the equity markets are way up, I might be thinking without even turning on this screen that I'm stopped out of this trade if I'm short the euro because of the relationship. If the equity markets open up down 200 points, I might be hoping that I'm right with my relationship, that there might be the euro US dollar might be in the 32 handle going down this way, and then I might be taking my profit based on support, based on other objectives and things like that. So that's the MACD. Very, very important, whether it's a bearish divergence, the market's going up and we think they're going to reverse, or bullish divergence, they're going down and we think they're going to turn around. This is a perfect example of it, and you could combine it with other technical information. If you knew nothing about MACD and just knew resistance, you could say there's resistance up here. If you knew nothing about resistance in the MACD and you used Fibonacci's, maybe you decided to 50%. If you knew nothing about just anything but equity market relationship and what the US dollar does, as the equity markets are kind of pausing here in this 13,000 area and running into resistance, maybe you say it's time to go long the dollar after a huge move down in the dollar versus the euro. So a very, very cool way to look at it. On this pretty short-term time frame, but it doesn't matter the time frame you're looking at. This works for a long-term trader or a short-term trader. You just have to see and understand the trends that are going on out there. All right, I'm flipping back to questions because I just ran off for a long time. So sorry about that. Both oscillators are showing return to uptrend, and the MACD is as low as about 15 days ago. Is this relevant for tomorrow's trades? It's a very, 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 very good question. I am an intraday trader in foreign currencies. I also use foreign currencies to hedge equities, all right, and hedge an equity portfolio. So very good point that it is low as it was back here is what you're saying. What does that mean? Well, price action-wise, we're down here, all right, and price action-wise, we're right here. So can the MACD go lower and lower and lower or stay low? Absolutely, because look back right here. Remember what I said, MACDs you're not using them in trending markets. So as the stock market trended up last week, this trended up, but look at the MACD, you're saying it's overbought. And if you sold the euro, guess what? You lost. And then here it is, the MACD is going down, and equity markets aren't going down, euro's not going down. Here's the MACD down, and if you're selling this, you're going no gains, and then all of a sudden this goes up. Price is higher here. MACD is basically the same place here as it was here. The price is higher. So that's what I mean by you have to understand other things. You can't use anything alone. You have to have an understanding of the markets. I just talked to a client tonight, and there's a fallacy out there. I can buy this software system and it's going to work for me. You have to understand who you are and and basic relationships and basic fundamental analysis and basic technical analysis, and then you can use an indicator. If we were bought some system that was the MACD only, well, great. We can't just turn it on and use it, because if we did and used it here, we're losing or scratching and scratching and losing and losing and losing, and we could have lots and lots and lots of losers and then finally a winner, and we'd still be down money. So we have to combine it with other knowledge. You have to be reading the blogs that I put for this macro knowledge so that you can get a day-to-day basis on it. Tomorrow, I don't know. I'm going to go to sleep tonight because I don't trade 24 hours a day, and like I said, I'm going to wake up tomorrow. If I wake up tomorrow and the markets are down, equity markets in the U.S., well, I'm probably thinking then that the euro hasn't retraced all the way back up here and stopped me out if I put my stop right here. It might have retraced up a little bit and then gone back down, but that's where I can use Fibonacci's and moving averages and other things just to kind of see. But overall, if we get 2 days of down moves in the stock market, that probably would be a good sign for this bearish trade. But when was the last time we had 2 days down in the stock market? So if I bring this up, just so that you guys can see what the stock market is doing. Let's see, I'm just going to bring up a new chart. So again, that's why these questions are cool, because it gets you thinking, gets me thinking about other things, about writing, you know, what people are looking for, what people are asking. So yeah, the MACD might be somewhat new to you, and you might be saying, based on the MACD, we're oversold. No way. We're not oversold if the stock market drops 20 points tomorrow, or 200 points tomorrow. We're not oversold based on the euro and its move. Look at the euro and what it's done long term. It's gone from 26 to 35. Could it go down a little bit more and still be very, very strong and bullish against the United States dollar? Yeah, it could drop this much, down here, down here, down here. So it's all relative to where, you know, when you got in your time frame of trade. You know, let's face it, the markets, I told you, aren't super, super volatile. If we look intraday today, this was a big move. Our high today was 34.84. And the low today was 33.10, so 180 pips roughly, 170 pips of movement today. That's bigger than it's been. Look at yesterday's movement, much smaller. Look at the day before, much smaller. So if you get 20 or 30 or 40 pips today, you're a hero. If you got 10 or 15 pips yesterday, you're a hero. You've got to let the markets tell you how much is relevant. I worked with someone tonight, a new client, and he's very, very realistic about what's going on. He just needs a little bit more fine-tuning with the fundamentals and the technicals and combining these, but at least he understands. And he said to me, Brian, if I can get 10 to 15 pips, I'm great. I said, man, I'm glad to hear that, because some people say, I need 50 or 100 pips. There's not 50 or 100 pips in yesterday. There's not 50 or 100 pips the day before. You've got to be realistic. Maybe you trade larger for a smaller amount of pips. Maybe in high volatility markets, like I showed you last summer, you trade smaller amount of contracts for less pips because it's more volatile, smaller amount of contracts for more pips because it's a 200 pip range or 300 pip range, and 30 or 40 pips is very, very, very easy to achieve. Whether it's a loss or a winner, 30 pips happen very quickly in a 300 pip range. 30 pips don't happen quickly in an 80 pip range. That's basically half the range. You're going for too much of that standard deviation, if you will. So I was just going to go back here and just show you the stock market and just show you on the periodicity. I'd like to change it here and go down to, the daily will be fine. But look what we're doing every single day. How many days have we gone down twice in a row? You know, it's not happening that often. So maybe tomorrow we'll get 10 days, 2 days, you know, a day down today in the stock market, a day down tomorrow. But I can't promise that. I'm not looking for that. I'm not guaranteeing that. So that's why I have to manage the trade and be realistic. And so whether you implement trailing stops to, protect your winner, whether you move your stops down, whether you take off some of your profits, and if you did 2 contracts, you take off 1 contract after 100 pips and say hallelujah, move your stop down on the other one, and then try and get 150 or 200 pips out of the other contract, whatever it may be. So very, very, very good question. Like I said, they lead to other topics. Let's see. What determines the center line of the histogram? So right here, it's a 12.26.9. This is what Gerald Appel, so Google it and you'll be able to read it. 12 period crossing over a 26 period, and then the 9 period is the flattening line. Okay, and every single software program will basically show it a little bit differently, but these histograms are showing the 12 versus the 26, and this flat line is the 9. So That's the math on it, if you will. Let me just see if there's another question. I think smart amounts traded more often is a good risk strategy. Also, yes, again, whoever asked that question, I don't know you. I can't go ahead and give that information. In these markets, you know, like I said, let the average trading range tell you. I don't know how often you sit in front of the markets. It could be 20 hours, it could be 15 hours, it could be 2 hours, it could be 1 hour. So you've got to make sure that the trading frequency is fitting how often you're sitting in. That's what I help people with, is kind of defining their trading personality, if you will. And that was the trading psychology webinar I did a couple months ago, where I offered basically people some time with me to go through that. So that's always out there. So going back into here, so we understand a little bit more how to look and how to use the MACD and the bearish divergence with other analysis, not alone, with other analysis. Let's face it, if you understood resistance and stock market and things like that and Fibonacci's, maybe you got in without the MACD. It's just something to help you looking for trends after a long term to start to fade away. I'm trying to think of a stock that was kind of acting like that, that's kind of gone awry a little bit. And so let me show you this as we wrap up. Let's go ahead and put in, if we can, AAPL. Let's see. So just take a minute to get these preset things off. And go ahead, and this might not pop up. So let's see. All right, so the MACD is basically on top, and if I change this periodicity to about this is going to be a lot of data, so it may take a while to come up on this software. But the point is, the MACD was showing an entry on Apple, and Apple went down, but then it came back up and surged to a new high. So again, that's where if you didn't manage the trade and have reasonable profits of an uptrend, which the trend is your friend going up, but you decided to go bearish on it, then you would have had to go ahead and make sure that you either got out for a small loss or you got out for some part of profit because you managed it, because the MACD said enter, Apple did go down, but then it eventually made a new high. So that's what I mean by making sure that you're managing the trade. So sorry this isn't popping up. It just is a lot of data. The Forex charts are popping up a lot quicker. So let's get ready to wrap up as we're kind of getting to that time frame. So we reviewed fundamental events. I brought in technical analysis and a key indicator, MACD, the bearish divergence, but we use that in context with fundamental news and technical intermarket relationships. Next webinar to be announced, well, I can announce it right now, it will be on range-bound trading activities. So if we have topped out here at 13,000 the S&P and we go sideways for a little bit, it might be range-bound. Foreign currencies might be range-bound, so we're going to do range-bound trading. You guys will receive a email about that, but that'll be in about 2 weeks from now. Same thing, fundamental analysis update, technical analysis update. Here's how you can find continuing education. Interbank FX's education site, their daily Forex trading edge, where I post almost daily, my blog, which is basically the same information, all of my past videos on YouTube, and then also where I post intraday on market activity on Interbank FX's Connect social site, where lots of people are posting their trades and posting their analysis. Do not follow me as far as my trades. Why? Because I may not be trading the same time frame, the same goals as you. Like I said, I use it to hedge. I use it to go ahead and trade short term. So you don't want to follow anyone unless you confirm that they're doing exactly what you're trying to achieve. All right? It's not good to just go, if someone jumped off a bridge, would you follow them? So make sure that you have an understanding of why you're following people on that social site. Just be very, very, very careful, because you may not know that person at all and what they're trying to achieve. The other thing I mentioned, I don't have a slide about it, is I kind of offered your chance. People who are listening in on the Interbank FX webinars, if you don't understand your trading personality, I'm offering time where we go through a phone call and I ask you pointed questions and I help you to hone in on what you should be achieving and what is realistic given my experience and given your personal situation. So if you want to take advantage of that, you guys know how to get a hold of me. My email is right there, and I'd be happy to set something up with you via Skype or via phone. It can be the best 30 minutes that you spend because maybe it brings new light from an unbiased outside source who just looks at you as a trading entity, and that's it, and basically tells you how he believes it should be straight from the hip. No BS or anything like that there. I'm a straight shooter, I can promise you that. So hopefully you enjoyed tonight. Please follow me in those various, as I click through here, the various resources available to you from Interbank FX, who's trying to do a great job of keep you informed of what's going on through its various education resources. Have a great evening, and I'll look forward to seeing you on the next webinar in about a few weeks. Thank you very, very, very much for your attendance.